Good morning. This is Michael Douville coming to you from beautiful Phoenix, Arizona. Tatum and I are in the studios, and we will make this broadcast available to you on the slides, the presentation, and hopefully we'll have this up on YouTube today. We're going to be very conscious of making sure that we take no more than about 20-25 minutes of your time. This is a Creating Wealth production, and we want to start talking about we have had enormous capital gains here in the United States in the last 10 years, and we want to keep them. And there are several strategies with which we can do this. So sometimes this is kind of a boring topic for a lot of people, but I'm going to tell you it is probably one of the greatest wealth producing topics we possibly can have, and that is handling your taxes. We're certainly not going to avoid the taxes, but we're going to either defer them or try and get them eventually wiped out. So we want to make sure that we keep as much as we possibly can. So our asset class, the real estate asset class, has generated more millionaires and wealth generation than any other asset class in the world. The real estate business it's a leverage business for the most part, and we have made tons and tons of people wealthy through the real estate industry. Now, in doing the research, I went back and looked at the last decade. And in the last decade nationally, now this is a Federal Reserve electronic data graph right in front of you. Now, this you can't get any more authoritative than the Federal Reserve. And nationally, using the CaseShiller Index, in the last decade across the country, real estate has gained 52.6%. Now, if you've leveraged that, you've done a lot better than that. But this is on a cash basis. So from asset price to asset price across the country, we've had a gain of 52%. Now, I keep crowing about Phoenix. Look what's happened in Phoenix in the last 10 years. Now, I've told you over the 35 and 40 years that I've been investing here in Phoenix, Arizona, that I've calculated that we get a 3.98% average return over that entire time frame, including the great reset that we had in the 2008, 9, and 10 area. But now take a look at what's happened in Phoenix in the last 10 years. We've had 85.9% appreciation in Phoenix. That's 60% more than the rest of the country. 60% more appreciation here in Phoenix than the rest of the country. Now, this has generated incredible capital gains for our clients. So we want to keep as much as we possibly can. And soon, you know my timing model. I keep talking about the timing model. We're very risk averse. So we want to make sure that the economy has turned and we're starting on the path to recovery. But soon, very soon, we're going to start buying, and we need a vehicle with which to sell one and buy two, because we're going to want you to start acquiring properties and get some real estate exposure. Now, whenever you sell, of course, Uncle Sam wants to get taxes from you. So how do we go about avoiding taxes? So there's several different methods that we can, and of course, we use a tax advantage real estate for yourselves. And let's just talk about some of the things. In real estate, we have huge tax advantages, but we're only going to talk about the 1031 exchange today, where we can actually defer almost all of the taxes. If we do it correctly, we can defer all of the taxes, and we're going to talk about inheritance. But keep in mind, real estate is a very tax advantage investment for people, and there's all kinds of reasons for you to stay in real estate for yourself. But let's talk about the fact, because we have so many capital gains in our investments, we want to keep those capital gains. And we want to save our taxes using a 1031 exchange. Now, Sheila Long from Old Republic is probably one of the most authority people I know. She absolutely knows the 1031 exchange business inside and out. She handles Southern California, Nevada, and Arizona. So when you say someone who knows their business, Sheila Long certainly does. So I want to bring her along because we're going to use this in our business. We're going to use this a lot. I just had a case. I'm going to tell you the very first thing that you ask when you're selling a property is, what are you going to do with the money? If the answer is, I'm going to reinvest it, you automatically have to say, I mean, it's got to just come out of your mouth and say, have you thought about doing a 1031 exchange? Most people do not know that, but we're going to talk about that today. So I'm going to bring in Sheila along with Old Republic Exchange. Hi, Sheila. How are you? I can see you there.
Good morning, Michael. Here I am. Hi, everyone. Thanks for having me.
Oh, you're welcome. Thank you very, very much for taking your time to come in and speak with me. It's certainly so. You know, for the most part, most of our my audience and people we do business with, they're small investors. They're going to sell one property, maybe buy two. Maybe they're going to have one that they have, maybe sell a big one, maybe buy three. They have all those opportunities with which to make choices, do they not?
Yes, absolutely. And that's what the IRS states under that tax code, is that when someone sells and buys again, they need to spend equal or greater in value. And they can buy as many as they want. So they can sell one and buy three, or they can sell three and buy one, and any type of property. Okay, that's what that like kind under the code means. And for those of you out here, that's the one thing I want to leave you with. Like kind simply means anything held for investment purposes. So you can have a client that is selling one single family and they can go and buy two, or sell one single family and go and buy two condos, or sell a piece of land and go and buy two single families. However they want to do it, they can absolutely defer and buy multiple.
Oh, what a wonderful vehicle. I don't know why everyone isn't doing this. This is absolutely, I mean, if you're going to develop wealth, this is absolutely the vehicle to do that, because I'm working with someone now. I think they have about $150,000 or $180,000 in gain if they conclude that transaction. Of course, even with the 20%, it's not just 20% capital gains tax. They've got the Obama tax, the 3.8% tax, and then of course they've got state tax. And if someone's unlucky enough to be in a high tax state like California, you could be easily leaving 30-40% of your gain on the table. And of course, that's just not necessary to do. So let's just outline this. So if we have a client that sells a property for $350,000, they have $200,000 in equity in the property. What we typically do in my business, I'm very, very conservative. So we would want to buy maybe two properties with that. So how would that work, Sheila?
Okay, so absolutely, they've got to make sure, the biggest thing is remember that to have 100% tax deferral, you must sell and buy again for equal or greater in value. And there are ways and calculations to figure out your adjusted basis. But the easiest thing I say is to just spend equal or greater in value. All right, they can take that, like you mentioned, and diversify. I would always look at, are they holding a loan on that property? See, when you have a client that is selling one and buying multiple, I don't think I would leverage both. I would actually say, consider replacing that debt on one and pay cash for the other. How do you think about that, Michael?
Very, very risk averse. Very, very nice. So if we sold a $400,000 property, we could buy easily two $250,000 properties or two 275s pretty easily. I would do that.
Yeah, or buy four, right, at 100,000 each in that scenario.
Yes, absolutely. And we're going to be getting to that time frame soon where we may want to do that. We're not quite as aggressive yet. I like your attitude, but we're not quite as aggressive. Here's a couple of questions that I get asked a lot with me, is that we have people that are holding their properties in LLCs. And that is, everyone can go ahead and exchange through an LLC, but there's an extra rule that one has to be concerned about. Is that not correct, Sheila?
That's correct. Now we're talking the difference in holding an LLC if they're a single member, or if they're holding it with their spouse, or if they're holding it in a partnership. And see, the IRS states that whoever sells must buy again. And if the LLC is treated, if it's regarded and has its own tax ID number, then it is going to have to be the one that sells again. So if ABC LLC has its own tax number and multiple members, then ABC LLC must buy again in that same manner. Now, there are some ways that you can try to plan ahead. I always say there's some advanced planning, and I'm not sure if you have time to go into that, but it is definitely something that they want to plan ahead for if they are trying to go their own ways. Say there's a multi-member, right? Two brothers want to exchange and one brother wants to run off with his funds. It does have to have some advanced planning, but in knowing this as an entity, whoever sells must buy again.
So it's pretty easy if it's just a family LLC, because we can keep everybody on the same page. I imagine when you start getting to where you have multiple people in an LLC, that's where everybody in that LLC needs to make the transfer from one property to the next, and then do any dissolution at that juncture. Is that correct?
Yes, or planning in advance planning is good too. So knowing that maybe you have, okay, we're in 2020 and we know in 2021 we're going to sell, right? And in that scenario I mentioned, right, where we have like, let's just say 3 siblings and 2 want to buy together, all right, and 1 wants to run off. Or maybe all 3 want to go their own ways, okay? What they will want to do is, with approval from their tax advisors, to consider maybe dissolving that entity even, or putting it into tenants in common and forming their own little single member, partnership. So now ABC turns into 3 siblings and each of them have their own entity, and doing this in advance will allow them to go their own ways as tenants in common. Okay, and that's very common. And when I have someone that knows that they want to do this, advanced planning is important, so that if audited, the IRS doesn't think they were trying to do something what's called a drop and swap, all right, or a swap and drop, where they're doing it after an exchange.
So the average mom and pop that are doing this, we really have no trouble with it. They're using an LLC for liability issues and just holding it. That's not going to be a problem. The only trouble that you're going to run into it is just when you have multiple parties, multiple partners, and the multiple partners need to make that decision. You just need a little advanced planning on that with your tax person, and that can easily be done. And no one needs to have a tax event. This can easily be avoided and moved into the next property. Is that correct?
That's exactly correct. You nailed it on that, Michael. Yes.
Okay. So I put up onto the screen here that this is just a really easy one for most of the people who are doing this, because most of the time we're just going to sell one, buy another, sell one, buy 2. They were typically, the typical investor is either holding it himself, or he's holding it with his wife, or he's holding it with a really close friend, and they're going to do this. So really, they just need to sell the property, take the money, send it to an intermediary. They have 45 days with which to find a property. And of course, you're going to be shopping before. Once you go into escrow, we've got an extra 30 days while we're closing. So it's really 75 days. But from closing to identity is 45 days. Is that correct?
That is correct. Yes. And that starts the day they close. That's day 0. As you can see down on the bottom of the screen here in green, right? And they have 45 calendar days to identify, which includes weekends and holidays. So it's really important to, yes, start shopping before that you've even closed. That's always the wisest thing.
So 4th of July and Christmas and all that stuff, those days are counted. So we may make sure, and then close within 180 days. I've done this many, many times. I've really never, ever really had trouble doing this. It's just such a sweet deal for investors to do this. So we've talked about the limited liability. I'm going to throw you a kind of a curveball, because we have a lot of Canadian investors, we have a lot of Europeans here, and they don't realize that they are able to do an exchange as well and save that capital gain. So is there any tricks that they need to do as a foreigner to do a 1031 exchange, Sheila?
Yeah, and I'm not sure if you want to talk about FIRPTA yet, or if you want to go through that next. Let's just talk about foreign investors and exchanging. If you're going to exchange in the U.S., you need to exchange back into the U.S. and U.S. territories. Okay, so if you have a client that is wanting to do an exchange outside of the U.S., they can do that as well, as long as they're doing it internationally. It would now become an international exchange, and they can say sell in France and go and buy in Canada, sell in Canada and go and buy in Italy, right? So that you can absolutely do that. You do need to make sure you're aware of the local laws. That's one thing that has come up, so that they're not running into any timeline issues. So remember, these timeline dates are very sensitive.
Right. So that's outside the country. So that would be probably not most of our investors, but it's really nice to know. So if you've got a vacation home, or if you're living in Canada and you're moving to New Zealand and you have a capital gains, the United States wants your taxes worldwide. So if you exceed the your gain and the taxes are higher in the United States than they are in Canada, the United States is going to want to get that difference. So that's how we're avoiding that. But I guess what I'm talking about is we have Canadian investors that are selling U.S. property and buying U.S. property. They too can avoid capital gains too on their U.S. holdings. Are they not able to do that?
Yes, they can. They can defer their U.S. holdings. We always suggest for any Canadians that are on here to also talk to their Canadian CPA, because Canada doesn't recognize the 1031 exchange, and they may have some taxes due, as well as just being aware of that. But they can absolutely exchange, and again, want to watch out though for FIRPTA, and which I know you're going to address here, but it is something that they want to plan and know. And there's ways around that as well.
So doing this 1031 exchange, do we avoid FIRPTA? I think we have to acknowledge it, but I don't think that we're triggering FIRPTA withholding if we do a 1031 exchange, if we do it pretty quickly.
So there's a couple rules that have to happen, okay? So if you're selling here and your buyer is acquiring the home and it is as their primary residence and the home is under 300,000, FIRPTA is not withheld. Okay, where they're going to have that withholding of 15% is if it's over 300,000. Okay, and that's what they have to watch out for. And one of the things that they can do is they can actually file for a certificate if they're wanting to do this. There's two ways they can do it. They can file for a certificate. It does take up to 90 days for the IRS to give that withholding certificate. Or what they can do is they can bring those funds in. All right, so they can bring in the funds, say they didn't realize that they did not apply for this withholding certificate. They are able to say, bring in whatever funds they want. Then when the IRS releases those funds are tax deferred. So they have to bring in the funds to close if they knew that withholding was going to happen.
So going back to this, it's just planning. So if you're working with your client and you know in advance that we're going to be trading out of this property, because typically what happens is that there's a tax reason for us to be selling this property, or we want to upgrade the property. So we know in advance that this is going to happen. You need to do a little teamwork. You need to talk to your title people, you need to talk to your 1031 people and your accountant. So you need to put everybody together and get that certificate, because we see it all the time. If you get the certificate, why you're golden, are you not?
Yes, and so here's one of those. I just want to give everyone that information. You can find that on irs.gov, and it's called the 8288B form that they can fill out. Just remember, as it says right here, that takes 90 days, up to 90 days for them to obtain that certificate. So typically, everyone up here knows, I know I'm going to sell in the next few months. That's when you want to start doing your research and getting with Michael or getting with myself, and we can kind of guide you in that direction.
So let's just recap. We're taking more time of your time. Thank you very much for this. Let's just recap this. So if you are a normal investor, you've had a property for 10 or 15 years and you want to sell the property, but you're going to take the proceeds and buy more property. So we can buy one, sell one, and buy 1, 2, or 3 more properties and kind of expand our holdings. This 1031 exchange will allow us to defer and carry on the capital gains to the next properties. Is that not correct? So
absolutely.
All our depreciations then gets a what's the correct word for that? It's transferred over to our other properties, but we're changing the base, because if we have depreciated a property, so our depreciation is probably limited, we can change it and get a much higher depreciation on our taxes too. So there's just so many good things that happen by doing a 1031 exchange as an investor. I don't know how, not only are we changing the base and raising that base, but we're avoiding taxes. And typically we're avoiding 20, 30, or 40%. So we had a $150,000 gain. I think it's pretty easy that we would have $45,000 in taxes that we're deferring. Would that seem reasonable?
Remember too, you didn't point out, there's also something called depreciation recapture. So you that are on here, remember there's a state, federal, and something called depreciation recapture tax.
Right.
And that's one sometimes in the market where you have someone that sold, say, or bought in 2007 and the market sort of did a downturn, right? But now it's come up again and they think, well, I don't need to exchange because I have no gain. I don't have any gain. I bought it for 5, I'm selling it for 5. But they forget 25% depreciation recapture tax. So
and
it's more
25%.
Yes,
not
above and beyond.
Yeah, so
You got it, 25%.
yeah, it's a fairly good bite. So lots of reasons to go ahead and do a 1031 exchange. I mean, really good reasons to do that. Well, Sheila, I'm going to thank you so very much for coming on to this webinar with us. And your information, I think, is on the webinar. Would you like to say how they can get hold of you in case they have any questions? Because I'm sure hopefully we've triggered some people who think I'd like to do this.
Yes, absolutely. The number one thing I want to point out, and leaving you on this, is to make sure you set up your 1031 exchange prior to close. Once it records out of your name into the new buyer's name, you no longer qualify for the tax deferral, even if you buy again. So it's so important to use a qualified intermediary and one that's nationwide and comes with backing. My name is Sheila Long, and my email, let me give this to you real quick, is my first name and my last initial. I think you can see it on the screen right there, right? Sheila L at oldrepublicexchange.com. And I will work directly with you to help make sure you understand this and point you in the right direction. And then my team will work with whatever escrow team is assigned. And my number will show up as well, but let me just give it real quick: 480-341-2032. So thank you, Michael.
Sheila, thank you for coming on. I really appreciate it. So and you've held our hand, you've held my investors' hand so many times, because once they've done it a few times, they feel comfortable. But it's the first couple getting used to it, and you have just been so wonderful in dealing with my clients. All right, well, thank you very, very much.
Thank you.
Bye-bye, Sheila.
Bye.
Well, that was Sheila Long with Old Republic Exchange. She is absolutely terrific. We did go over most of this FERPTA. I'm going to tell you, under $300,000, there is no withholdings necessary. That does not necessarily mean that you don't have to pay your tax. It just means that when you go to closing, there's no withholding. And really, again, it's plan. Make sure that you talk with your tax accountant. Make sure that you talk to your real estate agents and your 1031. So we put together a plan as to how we're going to do this for you. So we're running out of time here. I do want to get into this one of the most strategic possibilities for holding taxes and taking care of taxes. And we have that advantage here in Arizona. We're one of the only 9 states in the United States that have community property with right of survivorship. You really should talk to your financial planners as to how this is going to work for you, because it transfers property not only for real estate property, but virtually any property that's appreciated, you can hold as community property with right of survivorship. And the tax benefits are this side of fantastic. So if you hold community property, and as a baby boomer, one of us is not going to make it. So when we have a demise and we have a change in title, and if I die, my property goes to my wife on a stepped up basis. Now, as a community property, you get a double stepped up basis. So not only does my property get stepped up, her side of the property gets stepped up. So if we have $100,000 or $200,000 in capital gains, it gets stepped up to current value, and all of that gain goes away. It will never get paid, because if I bought it for $200,000 and it's now worth $500,000 and I die, held as community property with right of survivorship, my wife gets that $300,000 absolutely tax-free. Now, what about rentals? The same thing applies. And one other benefit. What about all that depreciation that Sheila was talking about that we're going to have to bring back at a 25% recapture rate? I die, we've depreciated $25,000 or $30,000 out of our property. All that comes back tax-free as well, and it just starts over. So if you have $10 million and you have $5 million in capital gains that you're liable for, one of the spouses die in a community property with right of survivorship state, all that tax goes away and your spouse gets it tax-free. Now, I'm going to tell you, you can do this in a LLC as well. You can hold these properties. You just have to make sure that you're holding your interest as an LLC as community property with right of survivorship. You can also hold accounts. Anything that's appreciated, you can hold as a community property with right of survivorship. This is again planning. You need to talk to your financial planner. You need to talk to your team members and say, look, if something happens, I just want to know what the mechanics are. And is there anything that we can do to make this better? And community property with right of survivorship, you need to just kind of investigate to make sure that your inheritance works, because it is just, here in Arizona, we are just absolutely blessed with this inheritance tool. It's just absolutely fabulous. So thank you so very much for coming today. We are going to make these workshop, slides available to you. We also have a workshop coming very, very soon. We're working with the state. We want to get open up so we can start seeing each other when we do these presentations. And you can raise your hand if you have any questions. Also, keep in mind that I have been really busy all last week. I had confidential consultations. You're welcome to call. I'm in the Scottsdale office. You're welcome to call at the Scottsdale office. You're welcome to email me if you want to sit down and just discuss your portfolio. We can brainstorm. We can do really find out what's best for you and make some plans for you. And I've had questions about the books. My book is sold absolutely everywhere in the world. So Barnes and Nobles have it. Angus and Robertson has that. Apple has that. Amazon has that. You're welcome to purchase it anywhere you want. You can call onto my website. We've got that. And if you need to reach me, we're here at the Scottsdale office virtually every single day working. So I want to thank you very, very much for your time. And if there's any questions, you're welcome to go ahead and email me. My very, very best to you. Bye-bye now.